As the dust began to settle from the initial market shock, the true economic and geopolitical dimensions of this trade confrontation came into sharper focus. What began as a unilateral tariff announcement had rapidly evolved into a multi-front economic conflict with far-reaching implications. Let us examine the comprehensive retaliatory measures implemented by affected nations and assess their potential long-term impact on the global economy. China's response was both swift and calculated, designed to inflict maximum economic and political pressure while minimizing self-harm. Beyond the headline-grabbing currency devaluation, Beijing deployed a sophisticated array of countermeasures targeting sensitive sectors of the American economy. The agricultural sector bore the brunt of China's initial retaliation. Beijing imposed prohibitive tariffs on a comprehensive list of U.S. farm products: chicken, wheat, corn, cotton, sorghum, soybeans, pork, beef, aquatic products, fruits, vegetables, and dairy. This was no coincidence. These products predominantly come from rural areas that formed a critical part of Trump's political base. Farm state senators and representatives immediately faced pressure from constituents seeing their livelihoods threatened. In Iowa alone, economists estimated potential losses exceeding $2.2 billion annually as Chinese buyers canceled orders and pivoted to alternative suppliers in Brazil, Argentina, and Australia. A soybean farmer from Illinois, James Keller, summarized the sentiment. "We've been through this before in 2018, and we barely survived with emergency aid. Now we're facing it again, but this time it feels worse because the tariffs are higher and there is talk this could last longer." His operation, which typically exports 70% of its harvest to China, was now facing potential bankruptcy without significant federal assistance. Beyond agricultural products, China halted purchases from 15 major American companies, many with significant manufacturing presence in Republican-leaning states. This targeted approach included aerospace components, heavy machinery, and specialized industrial equipment, all sectors with limited short-term alternative suppliers, maximizing the economic disruption. China also expanded its unreliable entity list, adding dozens of U.S. firms. Companies on this list face restrictions on market access, investment opportunities, and heightened regulatory scrutiny. For multinational corporations with significant Chinese revenue exposure, this created immediate uncertainty about their ability to operate in the world's second-largest economy. Perhaps most concerning to U.S. officials was China's move to reduce purchases of U.S. Treasury securities. As the largest foreign holder of U.S. debt, with approximately $870 billion in Treasury holdings, any significant reduction could potentially impact borrowing costs at a time when the federal deficit was already expanding. While China was careful to avoid disruptive large-scale selling that could harm the value of its existing holdings, even the signal of reduced future purchases created nervousness in bond markets. The semiconductor industry, critical to both economies, faced particular uncertainty. Chinese officials announced enhanced reviews of pending licenses for U.S. chip manufacturers and suspended several existing approvals, citing national security concerns, mirroring language often used by American regulators to restrict Chinese technology access. Canada's response demonstrated that even traditionally close allies were prepared to engage in serious economic countermeasures when their interests were threatened. Prime Minister Justin Trudeau, using unusually blunt language, described the situation as an unprovoked trade war against Canada and vowed a dollar-for-dollar response. Canada implemented 25% tariffs on $20.5 billion worth of U.S. goods, carefully selected to target products from politically sensitive states. These included steel, aluminum, agricultural products, and consumer goods. Canadian officials also threatened to extend tariffs to an additional $85 billion in imports if U.S. measures remained in place, a significant escalation that would impact virtually all cross-border trade. Provincial governments added their own measures. Ontario, Canada's most populous province, ordered the removal of American alcoholic beverages from provincial liquor stores, affecting approximately $700 million in annual sales. Provincial procurement policies were amended to disadvantage U.S. bidders, while Nova Scotia canceled several contracts with American companies. The energy sector, traditionally an area of close U.S. Canadian cooperation, became a flashpoint. Alberta Premier Sarah Johnson warned that the province was exploring ways to adjust pipeline flows in response to the energy tariffs, a thinly veiled threat that could potentially impact U.S. refineries dependent on Canadian crude. While likely more rhetorical than practical, such statements illustrated the deteriorating relationship between the normally close neighbors. Mexico's response, while more measured, nonetheless signaled serious concern about the sustainability of North American economic integration. President Claudia Sheinbaum announced targeted countermeasures focusing on agricultural imports from key Republican-controlled states. Mexican officials also initiated a review of security cooperation agreements, highlighting how trade tensions could spill over into other crucial policy areas, like immigration and drug enforcement, the very issues cited as justification for the original tariffs. The European Union, while not directly targeted by this round of tariffs, expressed alarm at the escalating tensions. EU Trade Commissioner Maros Sefcovic stated that the bloc was preparing contingency measures should the conflict expand to include European exports. Major European companies with significant operations in both the United States and China found themselves caught in the crossfire, forced to navigate conflicting regulatory environments and supply chain disruptions. Smaller economies highly dependent on global trade signaled their concerns. Vietnam and Cambodia, which had benefited from previous rounds of trade tension by absorbing manufacturing shifted from China, sought bilateral talks with both Washington and Beijing. Their vulnerable position illustrated how even countries not directly involved in the dispute could face significant collateral damage. The human impact of these retaliatory measures extended far beyond macroeconomic statistics. In manufacturing communities across the Midwest, workers faced uncertain futures as companies reassessed production plans. A factory in Michigan that produced automotive components for export to multiple markets announced a temporary shutdown, affecting 780 employees. The plant manager explained, "We caught in the middle of these tariffs coming and going in both directions. Our supply costs are up because of U.S. tariffs on inputs, and now our finished products face retaliatory tariffs in key markets. The math just doesn't work anymore." Small businesses lacking the resources to quickly reconfigure their supply chains or absorb higher costs faced particularly severe challenges. A survey by the National Federation of Independent Business found that 62% of small business owners expected to raise prices in response to tariff-related cost increases, while 41% were considering reducing staff if conditions persisted. The consumer impact began manifesting in retail prices. Major retailers like Walmart and Target issued warnings about inevitable price increases across thousands of products. A study by the Peterson Institute for International Economics estimated that the average American household would face approximately $1,700 in additional annual costs if the full range of tariffs and counter-tariffs remained in place for a year. Economic forecasters painted an increasingly gloomy picture. J.P. Morgan raised its recession probability for the U.S. economy from 40% to 60%, predicting the trade war could shave as much as 2% off economic growth. Oxford Economics revised its global growth forecast downward by 0.8 percentage points, noting that the spillover effects extend well beyond the directly involved economies. The manufacturing sector, already showing signs of weakness before the trade tensions escalated, appeared particularly vulnerable. The Institute for Supply Management's Manufacturing Index, a closely watched barometer of industrial activity, recorded its largest single-month decline since 2008, falling into contractionary territory. Employment forecasts were similarly concerning. Moody's Analytics projected that if the trade conflict continued for 6 months or more, up to 900,000 American jobs could be at risk, concentrated in manufacturing, agriculture, transportation, and retail sectors. These job losses would disproportionately affect regions already struggling with economic transition. The political dimension of these retaliatory measures was impossible to ignore. Each affected country had carefully calibrated its response to maximize political pressure while minimizing self-harm. By targeting agricultural products, consumer goods, and manufacturing sectors in politically sensitive states, they aim to create domestic political costs for maintaining the tariff policies. In Washington, the political response divided largely along partisan lines, though with notable exceptions. President Trump maintained his position, arguing that short-term pain was necessary to address long-standing trade imbalances and national security concerns. "We're finally standing up for American workers after decades of terrible trade deals," he stated at a rally in Pennsylvania. "We can take a little turbulence to get to a better place." Republican congressional reaction was mixed. Senate Minority Leader Mitch McConnell expressed serious concerns about the breadth and implementation of the tariffs, while Senator Ted Cruz warned of enormous risks if these tensions continue to escalate. Several Republican senators from agricultural states publicly urged reconsideration of the approach, highlighting the severe impact on their constituents. Democrats were more uniformly critical. Senate Majority Leader Chuck Schumer described the tariffs as an economic own goal of historic proportions, while Senator Ron Wyden called them poison for the American economy. However, some Democrats from manufacturing-heavy states expressed qualified support for tougher trade measures against China, if not the broader approach. The Federal Reserve found itself in a particularly challenging position. Chairman Jerome Powell, testifying before Congress, acknowledged the significant uncertainty created by trade tensions and their potential impact on monetary policy decisions. "We're closely monitoring developments and stand ready to act as appropriate," Powell stated, language the markets interpreted as signaling potential interest rate cuts if economic conditions deteriorated. For global supply chains built on decades of increasing integration and specialization, the escalating trade conflict represented an existential challenge. Companies that had optimized their operations for a relatively open trading system now faced difficult decisions about reorganizing production, sourcing, and distribution networks. A survey of multinational corporations by the Conference Board found that 78% were actively exploring supply chain reorganization, with 43% already implementing changes. These adjustments came with significant costs, Consulting firm McKinsey estimated that major supply chain reconfigurations typically cost between 15 to 30% of affected revenue over a 2-year implementation period.